Hello and welcome back to the Dukascopy TV studio. Now, 5 years after a devastating housing meltdown in the US, and new home sales have jumped 16%, the highest level since 2008. But is this housing pickup all that it seems? Here to discuss this is Dr. Frank Hollenbeck. Frank, thank you very much for coming in. Now, housing prices are on the pickup. The market is sort of on the rise again, which should boost the economy. But what's your take on this?
Well, for me, this is a classic pump and dump orchestrated by the central bank and its overlords, the banks in Wall Street. And of course, we have the National Association of Realtors who are in there cheerleading like they did back in 2005. And we have several statements from the NAR. For example, they're telling us that existing home sales have increased 50% over the last 2 years. The problem with that is that we're coming off a historic low. They're basically telling us that new home sales are up 20% over the last 2 years. And again, it's coming off from historic lows. And the NAR is telling us that we only have 1.74 million units available for sale, and that at current sales levels, we're going to run out of inventory in 4 months so that we won't have any homes to sell, and then shortly prices are just going to shoot up through the roof. Okay. Now, here is a case of reality. Let me tell you what reality really is. And currently, we have 133 million housing units in the United States. There are 150 million occupied housing units in the country, where 75 million owner-occupied and 40 million renter-occupied. This is a 13.5 or 18 million housing units are vacant. 4.3 million are considered summer homes, 3.9 are available for rent, which leaves almost 10 million homes which are completely vacant. It is true that 1.6 million are identified as vacant housing units as up for sale, but we basically have 10 million homes that are empty. Okay. Now let's look at the foreclosure. Let's look at the shadow inventory. Okay, which is foreclosures. Of the 75 million owner-occupied homes, 50 million have mortgages on them. Those 50 million mortgages, 1.9 million are in foreclosures. 3.5 million are in the process of being foreclosed. Okay, the 50 million that have mortgages on the buildings, we have 60 million individuals who are underwater. In other words, they're very likely to put their or just walk away from their mortgage. We also have a situation where even those individuals, okay, who are not underwater, okay, they're likely to put a lot of their housing units on sale. For example, I know someone who's 80 years old who got caught up in the housing bubble between 2001 and 2007, and she purchased 3 homes. Okay, now she's not underwater, but she's 80 and she should be a lot more liquid in her wealth. So she's going to be putting up her homes for sale. So when we look at the amount of available homes out there, we have a lot more than 1.74 million that's being indicated by the NAR.
So if inventories are, as you've just stated then why are housing prices going up?
Well, there's 3 main reasons, and most of them are, and they're all 3 temporary, why housing prices are going up. The first one is banks have slowed down the amount of homes available from foreclosure. That's the first thing. The second thing is that the central bank is buying up 45 billion of mortgage-backed securities. So in other words, if you have, this vacant building that's rat infested, if you strap on a mortgage to it, you don't have to worry, the central bank will buy it. And what we've seen in the last year is a growth of investment companies who are basically buying homes and turning around and renting them and financing it by selling mortgage-backed securities to the federal government. Now, we have to realize that sooner or later, this money printing has to end. Okay, what will happen is the either inflation expectations will be pick up and interest rates will pick up, or the Fed will get scared about the asset bubbles that it's creating. So we'll have a situation just like in 1937 when the central bank slowed down monetary growth, which led to a depression of 1937, or the serious recession in 1937. So we're likely to see interest rates go back up. Now, it is true that Bernanke says he doesn't see an asset bubble. Okay, he's basically saying he's not seeing an asset bubble in in equities. Okay, of course, this is the same person who told us that he didn't see an asset bubble or a housing bubble back in 2007. Now he says he doesn't see an equity bubble in stocks because companies have been very profitable. What he doesn't seem to understand is that it's not past profitability that's important. We just have to look at Apple stock to see that past profitability is not important. What's really important is future earnings, future profitability, and future sales. We can see that earnings forecasts have been declining. Okay, and if we look at bubble situations, we can see that a lot of the increase in the stock market today is due to leverage. In other words, we see stocks being purchased on margin reach the same heights that it did back in 2007. Now, if we look at high yield bonds, for example, there was a very good interview by Jim Grant that talked about a company that should be bankrupt and was able to place a couple $billion bond at 4.5%. That simply shouldn't be occurring. Okay, and when we look at farm prices in the United States, we can see that we're currently in a bubble. So sooner or later, the Fed is going to have to slow down its monetary printing, and when that happens, we'll probably get the same situation we saw in 1937. If I have any advice, it would be not to get caught up in this housing euphoria, because we're likely to see housing prices crash again like they did back in 2008.
Frank, strong comments as always. Thank you very much for joining us. Stay tuned to Dukascopy TV. We'll be bringing you the latest Commodities Corner interview, but for now, goodbye.